Welcome back to Intelligent Investment Today, the podcast devoted to all things value investing. In each episode, we take a closer look at a particular event, principle, or story from the world of finance, and we try to examine it through the lens of Benjamin Graham, the man widely considered to be the father of value investing, and of course, the mentor to Warren Buffett himself. Today, we're diving into a fascinating and frankly sobering story: the spectacular rise and dramatic fall of a hedge fund called Long-Term Capital Management, or LTCM for short. Now, this wasn't just any hedge fund. LTCM was founded in 1994 by some of the brightest minds in economics and Wall Street trading, including Nobel Prize winning economists and legendary bond traders. The idea was simple in theory, but extremely complex in practice. They would use cutting-edge mathematical models, arbitrage strategies, and most of all, heavy leverage to produce superior returns. And for a while, they did exactly that. Investors poured billions into the fund, and the returns looked dazzling. And the reputations of the founders gave it an aura of being almost risk-free. But by 1998, the dream had turned into a nightmare. LTCM had racked up such enormous losses that the Federal Reserve had to step in and organise a $4 billion rescue package just to prevent the fund's collapse from destabilising the entire global financial system. So today's episode is both a story and a warning. It's a case study in why intelligence alone does not guarantee success in investing, and why leverage, using borrowed money to magnify returns, can be as dangerous as it is tempting. So let's dive straight into it. As ever, sit back, strap in, and get ready to unpack the lessons of long-term capital management through the eyes of Benjamin Graham and the value investing strategy. So what do you get if you cross two Nobel Prize winning economists, a former vice chairman of the Federal Reserve, and a legendary Wall Street trader? It sounds like the setup to a bad joke, and in hindsight maybe it was. But in 1994, this group of financial heavyweights looked like an unbeatable team. The fund they created, Long-Term Capital Management, quickly drew in a who's who of investors. With resumes this strong, raising money was never going to be difficult. And by the time the fund began trading, it had already attracted over $1 billion from wealthy individuals and institutions eager to ride along on this bandwagon of intellectual firepower. The strategy was arbitrage, spotting small discrepancies in prices between related securities, usually government bonds, and exploiting them. These differences were tiny, but they believed their models could predict them with near certainty. And if you can find a trade that is risk-free or very close to it, the natural next step is to magnify it. And how exactly do you magnify it? With leverage. Borrow money, layer it onto the trade, and suddenly small profits become big profits. At least that was a theory. And in the early years, the theory seemed to work flawlessly. LTCM's returns in its first 4 years were 20%, 43%, 41%, and 17%. These were not just good, they were spectacular. And the reputation of the fund managers only added to the mystique. And of course, investors rushed to put in more money. At its peak, the fund managed around $5 billion in investor capital. But that was just the beginning. With leverage, borrowed funds, they had around $125 billion to invest, and controlled positions worth over $1 trillion. To put that into perspective, their debt-to-equity ratio was around 25 to 1. For every dollar of their own money, they borrowed 25 more. It was financial engineering on a staggering scale. And while the markets were calm, it seemed to work. Returns appeared steady, predictable, and safe. And investors started to talk about the fund as if it cracked the code of risk itself. Some even compared it to a kind of financial perpetual motion machine, a way of squeezing profits out of the market with almost no downside. But as any experienced investor knows, when people start to believe they've found a risk-free way to make money, that belief is usually the biggest risk of all. And it wasn't long before the cracks began to show. The late 1990s were a turbulent time in global finance. The Asian financial crisis of 1997 had rattled the markets around the world. And soon after, Russia defaulted on its government debt in 1998. Unfortunately for LTCM, it had heavily invested in emerging market debt, including Russian bonds. And when Russia defaulted, the value of those bonds collapsed. And here's why leverage went from being a friend to a mortal enemy. Because the fund was so highly leveraged, even small declines in asset prices led to catastrophic losses. By the summer of 1998, the fund had lost billions and was teetering on the brink of defaulting on its own obligations. At one point, the fund was down to around $400 million in equity, while still carrying around $100 billion in debt. At that point, it was no longer a question of whether the fund could survive, but whether its collapse would bring down the whole financial system with it. And there's an interesting side story here. In September 1998, Warren Buffett, along with Goldman Sachs and AIG, offered to buy LTCM's positions for around $250 million. He gave them less than an hour to decide. The offer wasn't just low, it was deliberately designed to pressure the founders into realism. Buffett knew that time was their enemy, and if they hesitated, the value of the fund would shrink even further. It was a classic Buffett move, disciplined, opportunistic, and focused on price over prestige. The founders refused, unwilling to let go of what had once been a $5 billion fund for what felt like pennies on the dollar. The offer expired, and within days, the Federal Reserve had to step in to organise a bailout. The Fed feared that if the fund collapsed outright, the domino effect on global financial markets could be catastrophic. LTCM's positions were so vast and so entangled with major banks and counterparties that an uncontrolled collapse might have sparked a wider crisis. So the Fed gathered a consortium of Wall Street banks who collectively put up $3.6 billion to stabilise the fund. In exchange, they took over 90% ownership. The original partners, whose stakes had once been worth nearly $2 billion, were left with virtually nothing. The fund was eventually liquidated in an orderly way, but the damage to reputations and the lessons learned remain with us to this day. So what can we, as students of Benjamin Graham and value investing, take from the story of long-term capital management? Lesson 1. Intelligence is not enough. The men who founded LTCM were brilliant, Nobel laureates, academics and traders of immense skill. But brilliance alone doesn't guarantee success in markets. As Warren Buffett once remarked, you don't need to be a rocket scientist. Investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ. Emotional discipline, patience and humility often matter far more than complex formulas. An investor of average intelligence, armed with the right temperament, will usually beat the genius who cannot control their greed or fear. Lesson 2. Strategies don't last forever. Even if you discover a profitable arbitrage opportunity, it won't remain profitable indefinitely. Others will inevitably notice and copy it, and that opportunity disappears. This is why Benjamin Graham's principles endure. Value investing isn't about exploiting fleeting opportunities. It's about consistently applying sound judgment and patience over the long run. Lesson 3. Beware of leverage. This may be the most important lesson of all. Leverage can turn small problems into disasters. When you borrow money, you surrender control. Lenders can force you to sell at the worst possible time. You may be right in the long term, but leverage can wipe you out in the short term before your thesis plays out. Lesson 4. Reputation is not protection. Many investors piled into LTCM simply because of the prestige of its founders. But reputation does not eliminate risk. A portfolio is not safer because a Nobel Prize winner designed it. And a strategy does not become bulletproof because a Wall Street veteran endorses it. As Graham might remind us, the market is no respecter of credentials. It rewards sound analysis and punishes overconfidence, regardless of who's holding the pen. To wrap up, we can say the story of LTCM is a cautionary tale that continues to echo decades later. It reminds us that even the most sophisticated models can crumble, that intelligence can be undone by overconfidence, and that leverage is a dangerous game to play. As value investors, we don't need exotic formulas or need to take excessive risks. We need discipline, patience, and the willingness to sometimes do nothing whilst waiting for the right pitch. As Buffett likes to say, in investing there are no called strikes, We can stand at the plate and wait for the perfect opportunity. So as you reflect on the tale of long-term capital management, remember our advantage as individual investors doesn't come from speed, complexity, or leverage. It comes from temperament, patience, and the ability to think independently. And that's all for today's episode of Intelligent Investment Today. I hope you've enjoyed revisiting this fascinating case study and drawing out the lessons it holds for us as intelligent investors. If you have found this episode valuable, please consider subscribing, leaving a review, adding to playlist, or sharing it with others who might benefit. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.